Hey, this is Maj Souedan from Geo Investing. I'm here with Sean Westropp of Deep Cell Capital.
Hey, how are
And
you?
I'm doing great, man. I'm really great. I'm glad you did this. I know I followed you on Twitter for a long time and I've always wanted to have a chat with you. And
Yeah,
I don't know
yeah.
which tweet, I don't know which tweet it was that kind of got me going recently, but it was a stock maybe we both had some familiarity with.
Okay.
And I went and read some of your letters. I was, wait a second, I know a lot of these stocks. So,
That's
uh,
good though. Yeah,
and
it seems like
so
there's a lot of crossover in the microcap space.
yeah.
Microcap and small cap guys seem to know each other, but
And you do some like short selling and long. So that I think that's
yep.
where we connected a little bit. I think because we did that at Geo for a while,
Okay.
and I noticed that. So I want to definitely with a lot to talk about today for sure. I mean,
Okay,
I've gone through
great.
some of your letters. You're doing a good job. I like your focus, and so this will be a lot of fun. So what what's so we like to start these, Sean. Give us a little idea who you are. How you got into what you do now. I mean, are you a full time investor, part time investor? Where you heading to?
Yeah.
Maybe some your journey that got you to this moment.
Yeah.
I
No,
love to hear it.
that's perfect. Yeah. So kind of been an investor for a very long time. So I started investing when I was like 14 or 15. Kind of got into it by watching CNBC. So I grew up playing a lot of, video games and messing around with a lot of different kind of like business investment, business ideas and things like that, like ticket resale and try to make a website. I tried to make like a Porsche website one time, Porsche fan website. So kind of like messed around with a lot of that, but got into investing kind of like in my teenage years.
Okay.
Got like one of those early brokerage accounts. I can't even remember the name of the company. I gotta look it up, but it's been long bought by TD Ameritrade, through like three different,
Right.
acquisitions. So, but yeah, I think I was paying like $19 or $20 a trade back then. Which when I only had a few $1,000s was quite a lot. I had to make sure your trades were worth it. Uh,
Right.
but yeah, so did that and went off. Spent some time in the corporate world and went back and got my MBA around like 2012 at University of Chicago. And after that, I kind of like, I'd been doing the investing kind of on the side for a long time, and I felt like, yeah, I'm going to do this for the rest of my life. This is something that I'm really into. I get excited about. I found that I was just spending a lot of my time, either outside of work or even, during work hours, checking the market and things like that. So
Right.
so started a fund, just an incubator fund with some family and friends' money right after school. And it's been about 6 or 7 years now
Okay.
running that. And then in June of last year, launched Deep Cell Capital, out to accredited investors. So it's a long short fund, basically the same strategy I was running at the incubator fund. It's net long most of the time, so it's a long bias. Shorts usually in the kind of like 30 to 40% range, and longs kind of vary between 120 and 150.
Mm-hmm.
So the focus is really around three different areas. So the first being microcaps, and the second is the quality stocks. So looking for like quality growth stocks, things that can compound for a long time. I kind of was led to this. When I originally started, I kind of was like a Graham and Dodd investor coming out of University of Chicago. They really like hammer that into you, that markets are
Right.
efficient and you can't beat the market, so
Yeah.
that type of thing. And then you get out and start doing it, you realize that that's not the practitioner's way,
No,
right?
no.
Um, you
They
know,
can't beat the market because they're doing what everybody else is doing.
right, exactly. Yeah.
No.
Yeah, especially when you're shorting things and you're like, wait, why does this keep going up? And you didn't
Yeah.
realize all the flow dynamics and different things that can can go into a short. So then kind of those so microcap, quality, and then special situations on the long side. And then my short book, I mainly focus on things like pump and dumps, frauds, or like what I call moonshots. So things with like almost no revenue that have gigantic equity value. That's
Right.
kind of a newer thing, actually. In the last few years, there weren't a lot of public market companies that I would consider moonshots like 4 or 5 years ago. But with the whole SPAC bubble and everything, there's
Oh
probably
my God.
yeah, I mean, there's probably
Yeah.
50 of them out there where they have zero revenue and it's all just built on a dream. You know, they really
Right.
shouldn't be public companies. A lot of them, they should be private companies, but they are.
Well,
So
well, a lot of those SPACs, Sean, they went public because the only way they could raise it, get any money or Lifeline was going public. I think it was
right.
a last ditch effort to get some money and fool the market and, before they go out of business.
Yeah, I mean, and a lot of these just require so much capital to really get
Yeah.
off the ground. Like I mean, all the EV companies, these EV toll companies that are out there now, and
Oh, ridiculous. Yeah.
some of the some of the quantum computing companies. Like there's just like clean tech as well as there's a fair amount in that space.
Yeah.
Too,
So
so that's how I run the fund now, and yeah, it's been a little over a year, and just continuing to chug along, raise money, and yeah.
So I want to come back to your fund in a second, a little bit, but let's talk some things you brought up really resonated with me a little bit. I mean,
okay.
So first thing I want to talk about is like, I remember when I was in college, and I'm a little older than you, and had a similar kind of path experience when I was in school. And I remember I was taking my maybe my third year in college, and it was I had a portfolio management class and then an investment class. And I remember like the portfolio management class, everyone was afraid of the guy. He was just angry, white beater shirt, half sticking in. He was just really, really an angry guy, not happy. And, he's just drinking his coffee and he's like, oh, you're going to fail this freaking class. And, you can tell he hated his job and hated investing because he couldn't beat the market. So
he was market guy there, I'm sure. Right.
And he was talking about the efficient market theory, and he wrote a book, of course, and that was the book he was using to teach. And it was all about how, 12 stocks, you can't go past 12 stocks and these things. And I remember him taking me, I had a question because I was relatively new to the investment game back then in terms of theory. I was investing a little bit, but I didn't know like a lot of theory behind it and didn't understand some of the concepts. And I would go to him and he said, and ask him questions. He goes, you're not going to pass this class, man. Just forget about it. Wow. So it was pretty funny. Yeah, it was a great teacher. Yeah. So I did okay. Yeah. So, the journey that you took there is interesting because, when I first started geo investing in 2007, I was a long only guy. And then we were investing in a lot of these China frauds. I don't know if you remember the whole China hustle thing.
Yeah. Like 2014, 15-ish.
Well, 10 to 14. It was still going on now, by the way.
Like the reverse mergers.
Yeah. But we played a pretty integral role between 10 and 14. Buddy Waters was part of it.
Yeah.
I had a lot of people doing it. What was his name? Citron.
Andrew.
So it was but I found, I was actually long a lot of these companies. And Gio was talking about them, and then we had to flip the switch and start doing the investigations.
Yeah,
we uncovered about, I think it was 12 or 14 China frauds, 23 U.S. pump and dumps. And I was reading your stuff, and you talk about shorting pump and dumps.
Yep.
Which was kind of cool. I saw that here, and that market's changed a lot. The way the pump and dump works has changed over the last 15 years or whatever.
Yeah.
And you got involved with the First Family and Friends Fund in about 2017, 18.
A little bit before that, but yeah.
Okay. So cool. So you had an interesting, the pump and dumps were they.
I think I kind of missed most.
You missed a big part of that.
Yeah.
Yeah.
I do remember them from kind of like the long side because they always seem to look cheap, but I think we all learned a lesson on that one.
Yeah. Well, the pump and dump kind of thing, I know, is kind of evolved, Sean's like when it was the OTC penny stocks, where it all lived. Now it's like NASDAQ. You look at pump and dumps on regular exchanges now, right?
Well, I think it's gotten a little more sophisticated with how they actually go about it, and like they clearly understand that the float dynamics are a key part of the pump and dump, right?
Right.
So if they can keep the float down, which like a lot of these companies, I mean, we saw what happened with Tilray back in, what was it, 19 or something like that, where it was clearly not worth, $100 a share or whatever it was trading for. I think it went to 200 at one point, but there was no float and all these ETFs had to buy it. They had to go out and buy it because it was, it was NASDAQ listed, and I think it got added to the Russell 2000. And so, and they just constrained the float so much that, there was just, you couldn't get any borrow on it. So we went to the roof, but I think people learned from that, and it's more of what's going on. I mean, I've seen a few, of those type of things over the years,
right?
On the flow constrained pumps.
Yeah, it's scary doing. I've kind of gotten back into shorting a little bit now.
Mm-hmm.
On a personal level, we don't do much of it at Geo anymore.
Yeah,
but it's still I'm taking very small positions in them. And when you talk about moonshots, so I kind of I understand your category you're looking at, like the zero revenue.
Yep.
But there's also that like level of company that has revenue, but they're losing like 10, 20, 30 million a quarter. So there's still 1,000 companies over $1, I think, losing 20, 30 million a quarter or some kind of number like that. It's crazy.
Yeah.
And that's going to slowly go to zero, right? I mean, but we don't know what happens in between.
That's I think the big problem, I think, or the big question right now is what happens to all these, how long it takes for them all. Like, there's no way they can all somehow get to, cash flow break even.
No.
Especially the size and how much they're burning. So I think you're right. I think a lot of them, we've seen it kind of like with, with a few of them recently, like Lordstown, and that one, I mean, that was a little more complicated, because they had the backer and everything back out. But, I mean, I think we're going to see a fair amount of bankruptcies over the next, call it, 2-3 years, as all the capital dries up and, for raising money for all these companies. At this point, I mean, it seems like, there's a lot of them that are, they'll do the pump, they'll put the shelf out and raise some money from investors and keep it chugging along, at least for now. But it's just kind of, they're just burning equity at this point.
I think Pixie was one of them too. PIXY, that was one that Shift Pixie. Yeah. Yep. And but I think what's different now than before was that these companies were able to survive, and because they had an unlimited window to either sell an equity at decent, decent valuations, above where they were worth, and you could go get some debt. And now you can't do that, right? Now you have the only way. So the market knows that, and they're going to keep raising money, but it just keep lower.
They're going to burn their way through all of the. Yeah. No, I think there's a lot out there still like that.
I think there is. I just don't know how to play
drawdown right after the kind of the bubble and SPACs. I mean, like, there's very few SPACs that trade above $10.
Oh, it's crazy.
I mean, so most of them are underwater. But all the SPAC sponsors, took their cut and walked away.
Of course,
not a bad gig, honestly. I think they were pretty smart. They knew it was a kind of a frenzy. So, but now they're just left with a bunch of weird public equities that have, kind of like no chance to really make it. Some of them have really traded down, and then you've seen like a lot of them, because the short interest is so high, have been spiking 200-300% in like a couple weeks. There's a couple of the EV ones that I think are up 300% in like the last month.
That's crazy. And you look at that, and you're investing in your quality companies, and and you're just waiting for them to do the same thing, and they just don't, right? It's a slower kind of up, a normal way of going up, which is kind of weird too. Is like, how does all that money find the fraudulent stuff or the stuff that's going to go to zero eventually, and not find its way into this great stuff that's actually working?
I think the last month and a half was, the algo definitely was geared towards the short interest, right? So the short interest factor was what drove everything, So if you had any short interest, it was just trying to pump, those stocks up as much as possible. And I mean, the whole retail, there's definitely a fair amount more retail money, I think, in now than there was, 4 or 5 years ago. And
for sure,
they're just chasing that next. Retail traders just chasing that next pump.
I think they had 10 million retail investors came in the market during 2020. That was the big stat.
There was so much money floating around, right? It was like the only thing you could, and you were sitting at home. It was the only thing you could do.
Right. So let's get a little bit now into some of your investment process and things like
Yeah.
that. And now, so you have some focuses here. Let's talk about the industries here first a little bit.
Yep.
I have here tobacco, tower companies, medical instruments, medical diagnostics, serial acquirers, software,
Yep.
financial services, payments, gaming, and internet and e-commerce. Now, is this the focus on both the short and long side? Maybe your long side right there.
This is the long side focus. So shorts,
Okay.
I'll kind of go
I need,
wherever the market takes me.
oh,
Wherever the most outrageous valuations and clear management issues or business issues take me. But yeah, on the long side, yeah, I try to focus in those specific sectors. I will kind of venture out a little bit into retail and things like that, but not materially. And those are just sectors that I found that I can, they kind of have a couple things that I like. Well, one, I can understand all of them, or I do understand all of them. Two, they have good long-term economic models where there's some sort of IP in the case of like the medical stuff, or some sort of some sort of moat around the business, like in case of the towers, like there's real estate, there's only so much real estate, and there's permitting issues and things like that keep it they keep the returns high over long periods of time. That's what I'm looking for on the long side, is businesses that can have outsized returns on capital and sustain those over long periods. So that's kind of why I picked those sectors, or those industries, is that those have basically shown to be able to outperform on a return on capital perspective for a long time.
Okay. And when you're on the long side, I mean, right now you have a few companies, but what is your kind of, I'm looking at your stuff here. What is your view on concentration, diversification? Let's go.
So usually, I usually will try to focus. I'll try to have about 20-ish longs and then 30-ish shorts. And the reason is the shorts are usually smaller, just because I've learned over the years that you don't want a large short exposure in a single name, just because you never know what can happen, especially, if there's high short interest or something like that, it can go very badly for you very quickly. So yeah, try to spread the shorts out a little more than the longs. But yeah, and then usually sizing wise, the longs, like kind of like my full size position on a long would be about 10%, and a full size position on a short would be like 3 or 4%.
Okay.
So yeah, the shorts are much smaller.
Now, are you basically so pretty much diversified across? Are you taking so you're 3 to 5%? That's about it, and that's okay.
Yeah, I mean it definitely varies. Like the more conviction I have on certain names, will vary. So I'll usually probably only have 3 or 4 positions kind of at the max position.
Okay.
And same on the long side. And
now,
then everything else kind of is based on, I do trade a little bit around technicals and things like that. So I do actually in my past, I've kind of tried tons of different investment strategies. So I kind of mentioned I was Graham and Dodd value guy for a while. I traded options, using, technicals in my, right out of college in my 20s.
right.
So I know kind of the technical side as well. So I do try to position things a little bit, just using technicals and things like that.
Interesting.
Cut, trim things when they get a little too expensive, or the chart's just looking a little toppy, and kind of the opposite at the bottom. So yeah.
So are you when you have these weightings in your portfolio, you might start somewhere. Are you actually continually rebalancing based on not just technicals, but also on the weightings?
On fundamentals as well. Yeah.
Okay.
Yeah. Usually I mean, I'm not doing it every day, but yeah, I'm always looking at it and always trying to rebalance based on, if there's a big earnings change or something like that, or, negative, news item that changes, my, confidence in the company or the management or something like that, I'll, trim positions. Or I think if I really lose confidence in the management, I usually exit positions. That's the one thing that I found that is just kind of like it's either a check or there's a checkbox next to management or there's not. There's not like a half check next to management.
Right.
So you either like trust them and you think that they're a good outstanding management team, or you don't.
Right.
So if you don't, you shouldn't be invested on the long side.
Right.
So when I lose that check, I usually exit the position.
Okay, cool.
Yeah.
I know I kind of with you on that too in terms of technicals. I mean, I'm not a technical, chart reader necessarily, but I use momentum a little bit in my analysis. So I'm looking for one part of it. I mean, I'm a contrarian too, but I think momentum plus GARP is a very strong strategy in the short run if you can find these.
Oh yeah, definitely.
And so I do a lot of that myself, and I've gotten more diversified too. I mean, I started out very diversified. I came out at a pure lunch, owned 1,000 stocks. Like I'm going to do the same thing. I had like 400 at one point. It was crazy. Then over time, I came down to where I was very concentrated after 08. And now I'm back in that 20 to 30, 40 kind of mantra where I'm doing something like what you're doing a little bit.
Yeah.
What I've kind of found, Sean, is like, investing in nano caps. I mean, if you look the empirical evidence of investing in small cap stocks, you already win doing that to some degree.
Yeah, definitely.
Jim and Sean actually talks about it, and you get this like I think 8.24 advantage over larger cap companies, over the largest versus the smallest decile. Mm-hmm. So that's from doing nothing, and he's not even looking at under 100 million really. He's going from he's not even going nano cap in that.
Yeah.
So, but what if you do a little research into that little pool, right?
Yeah, exactly.
To look for the best companies. And but what I'm thinking finally is that it's harder for me like to time some of these moves. So if I have exposure to maybe a lot of these great companies I like, I never know when one of them is going to go up or down. That's why I want to have a bunch of them, and that's kind of working well now for me right now.
Yeah, that makes sense. Yeah, I mean, especially in micro caps, like even if you get kind of like some good earnings one quarter, it may not really move the stock because people are hesitant, without an analyst out there, cheering on the stock and giving you, oh yeah, they're going to do this amount next year in revenue and EBITDA, and they're going to, be able to sustain this. You have to kind of like believe in it yourself, right? And you got to go out. So I think it takes a little longer sometimes in micro caps to really like, you really get moving. So yeah, no, I'm with you. That makes sense. Yeah, I try to find. I mean, I am looking for in the microcap space. I'm looking for things that I think can be significantly bigger, 3 to 5 years.
Okay.
So I'm trying to find the ones that I think in my head are those companies and try to hold those, as best I can and not trade around the microcap stuff as much.
Right.
More of my special situations and quality buckets. I'll trim and that type of thing a little bit more. But yeah, I think you're probably right on your strategy there.
I mean, you're already hunting in a great place as it is, and if you can find the best companies in that space, if you can, you're not saying it's easy, right? But you should have the advantage. Yeah. But so if we talk about, let's talk about interesting. We'll come back to stocks in a second. And you write as I told you, I was reading your letters, and in your last letter, you had a nice little passage. You talk about the stocks you're investing in or shorting. Yeah. And you kind of give a brief summary of what your view on the market is. And we talked about moonshots, but I guess you're talking about kind of a mini rebubble going on here. And then you kind of said here, I'll just read the whole passage and then we can talk about it a little bit. Okay. We have come so far in the last few months. We went from VCs, this is, I guess, beginning or begging for the FDIC intervention in the Silicon Valley bank failure in March, to a mini rebubble in which low quality, long duration equities caught fire again in June. Many of these companies are moonshots, which you've explained earlier what they are. Yeah. These are zero revenue companies. That should go to zero hopefully one day, if you're short. Which are companies that have no revenues, high barriers to delivering a viable product, and require a significant amount of capital to fund. Alongside moonshots, we saw several pump and dump companies emerge with the AI product in the second quarter. The markets clearly feel a bit like 2022 again, at least in the low quality end of the market. Can you, I mean, we talked about it. Anything else you want to add to what you said earlier? I mean, that's a interesting perspective, and I think I kind of agree with a lot of it. So maybe you can.
Yeah, I mean, I think we kind of talked about it a little, but Yeah, it definitely felt like kind of like mid-June, there was a pickup, kind of a bottom in a lot of these low quality, kind of like pump and dump, or very, these moonshot type companies where they all kind of are down 90, or a lot of them are down 90-95%, and they just, I think, couldn't go down any further. And once they cut that momentum up, a lot of them just kind of like took off. There's a bunch that are up 400% now. And some of them have sold off a little bit, but yeah, the AI seems to be the new bubble, right? We had kind of like the EV bubble for a while, and now we've got kind of like AI and EV tolls is another big one. So like Jobby and Archer, there's probably about 6 or 7 EV toll companies that are actually public, and I think maybe only 2 are maybe really gonna potentially deliver a product.
Right.
The rest probably not. Archer may have some military, they just got a military contract the other day. It sounds like they might have some military applications, but these EV tolls are, in my opinion, they're more complicated than a helicopter, right? There's more moving parts. They are quieter, and they're, I guess, more fuel efficient, but they don't really do anything that a helicopter can't really. I mean, I guess they can operate a little bit more in residential areas because of because they are quieter, but most of them still need a pilot. So you're still going to have to pay a pilot. There are some that are working on, where they would have some AI that would actually, fly these things. But, the barriers to actually getting these to market are huge. They still have FAA approvals that they need to go through. Jobby just got, it was basically a rubber stamped FAA approval so that they can start testing, which sent the stock up, like 250%, which basically you just have to prove that you have a product that you want to test. It doesn't actually mean that it's safe or anything like that. So yeah, I mean, a lot of these are just, not ever going to come to fruition, and they're just going to drag and drag for years and years and years. And maybe 1 or 2 of them find some military applications or things like that. But I mean, the question I think most investors should be asking is, why is it that these startup eVTOL companies are out there and the Boeings of the world aren't in this space at all? Like, why isn't Boeing making an eVTOL? Because they clearly know that, it's not going to be viable, right? Or if the case is that they find some niche application, these companies may come in and buy them out of bankruptcy or something at some point. But there's just these valuations, $10 billion, and I think Jobby almost hit 10 billion at one point. Yeah, it doesn't make sense to me. But
are you shorting these names?
Yeah, on and off. They pump. They've been up a lot lately, so I risk manage some of them on the short side, which just means close them at a loss. Hope to get a buyer.
The fancy word for a lot.
That's what that means. But you get, that's why you got to be small in these names. They can go up on news.
And you got the interest expense you got to pay on the borrow, right?
Yeah, borrow. You got to be the shorting is, I mean, the hardest thing to do in investing, I think. Run a real good short book that delivers alpha is tough. Absolutely. You got to watch so many factors. You got to watch borrow. You got to watch, the float. You got to watch, just the sentiment of investors and tons of things.
No. But and even if any of these companies do make it, are they going to make money too? I mean, it's like they deliver a product, but then what happens?
I mean, like look at helicopter makers. Like they're not highly profitable. Like they make single digit margins. So that these companies would be very similar to them. It just doesn't make sense to me.
Now the flip side, though, as even you talk about the moonshots. You talk about the AI, kind of pump and dump, but you're also giving credit to AI too. You think there's actually going to be, it's going to be really good for the market, maybe in advances in technology and ways for companies to do things to make their lives better, right? To make their kind of companies more efficient. So talk about kind of how you feel about AI and how you're actually positioning yourself there. When you look at a company or look for those opportunities.
Yeah, I think on the AI side, I think it will be another leg kind of in this multi-cycle, computer kind of infrastructure cycles that we've had. So we had like kind of the mainframe, then the personal computer, and then mobile, then cloud, and now kind of AI. And so I think AI will be more from a corporate spending perspective around it, continuing what a lot of work has gone in probably like the last 10 years around productivity improvements. So moving from like Excel to like smart sheets, and moving kind of like, towards like data IQ, data ingestion, all those sort of things to make daily corporate lives more effective and more efficient.
Yeah.
And I think that just continues with AI. You're just going to have AI continue to push and make, corporate lives more efficient and more effective, and less data intensive, and then probably utilizing data more, right? So you're going to utilize, that's what AI is going to allow, is for corporations to use data more to make decisions, or all sorts of different things.
Right.
And then I think there's probably some applications that we can't even really fathom yet that will come out of AI that will really push things. But I do think that probably without the AI kind of like coming in, we may have seen a recession kind of like in the end of the year. But I think there's a lot of, when you have like these big swings come in, a big new, big new technologies and things like that, I feel like corporate decision makers can kind of get a little bit afraid that, oh no, we got to figure this out,
Right.
figure out what we need to do. We don't want to lose our business. Like, so let's go spend some money here, or we'll spend on some consultants, or we'll like start a team around AI. And, you've seen all these, press releases, and, almost every earnings report that you read has something about how this, XYZ company is starting an AI initiative for this specific product.
Right.
So like that, that does come through to spending on things like consultants and, data. And I think a lot of the near-term impacts will be kind of like in a lot of the software infrastructure companies where, where really they are, they are dependent on how much data is out there and data is used and how much compute people use. So I think those we'll see kind of an upside over the next, call it 12 months. But then, I don't really know how it's going to play out over the next, 10 years, but it's definitely something that I think will be a focus. Kind of like cloud is kind of still going to be a big spending, line item for many companies, but I think AI will kind of creep up over the next 3-4 years.
Yeah, I kind of agree. And I was actually talking to a company this morning that I own, and we were chatting, and he was, what can you do to keep on, to jumpstart growth, or to not only help themselves be more efficient, but also get more customers. And it came back to AI again.
Yeah.
What can we do for our organization to make our structure more efficient, and what can we offer our clients from an AI perspective? I mean, they're not an AI company, but they're just trying to understand how to make it work to move forward. So I think you're actually right in the spot.
Yeah, I think too, there's a lot of things that have been gone on in automation too, over the last like 5 or 6 years. I used to be an investor in Cognex like a long time ago. They do like some of the vision stuff, but yeah, I think on the automation side, tied with the AI, where you can kind of, I think a lot of that will come through even on the industrial side a little bit. Kind of like 5 years down the line, you'll start to see, more automation coming in to, a lot of industrial companies that could, really reduce costs and things like that, improve margins.
I think what's funny though is that, AI is getting all the rage now, but there's been companies that you would call what they've been doing for years already AI.
Exactly.
Taking the data and doing things with it and understanding how to, how to process it is really AI. I mean, it's just exactly. Now it's maybe like it's more of a consumer. I mean, the consumer sees it now as a product. So now that's how we can.
Yeah, I mean, I think that's kind of what ChatGPT did. It kind of like proved out, hey, AI actually is a viable product for the consumer, and that kind of like jump started everything, right? Because everyone was, oh wow, you can actually use this for something, reel that actually, has pretty big upside. I've used it, I've played around with it. You can do all sorts of things to improve your productivity and stuff like that. So I think that just kind of like got into everyone's head, and especially corporate leaders and things like that. They're probably worried about I know, like, I've heard where they've shut off ChatGPT at a lot of companies.
Really?
They're like, I don't know if they're worried about people doing their job too efficiently. I don't know, but like but
it's funny, John, because I have an outsourced marketing once in a while I use, and I'm like, all right, I gave him a task, to do something. Like, wait a second, this sounds like it's like it's good, but I know you didn't write it. So for a second, I was like a little upset, right? And I'm like, you know what? Fine, you're doing a better job now, probably more efficient, man.
Right.
And, I didn't call her out on it. Because I want to see how well it goes. And then there's also, even with my staff, I remember like a few days ago, we're talking about we're on a Viber call. And we're all talking, and we're having a strategy session trying to understand how to do something. I'm like, you know what? Let's ask ChatGPT. We've been here for 10 minutes going back and forth.
Right.
It was actually, it made sense. So it's already helping me be more productive around my staff. And when we're in these kind of like bottlenecks about maybe strategy and marketing, these kind of things to help market geo investing.
Yeah.
And it was, or if I'm writing an article and a research report in a company, I used to go, I'll use ChatGPT now to get me, a little bit of information on that, and to understand something. I think it's really helped me. Google's great, but Chat just does it differently. I mean, it's more engaging.
It's much more targeted.
Yeah, you think more critically
Google,
a little bit.
I think it's sometimes I search Google now and it's like not even what I'm looking for.
Yeah, what was I doing?
It seems to be like, I don't know how much they care anymore. They're just counting their ad dollars. But yeah, ChatGPT, I've even used it for things like my son was like the MC of this little talent show that they had. He's like in fourth grade, and he had to do some intros. It was like intro for guy playing the piano, and we were like, what are we gonna say? Like, we were like, ChatGPT, write a small intro for a guy playing the piano, and it was like reasonable. It was not okay. So yeah, it's like, it's quick, it's easy, and it's like 95% there. So
yeah, what I like about it too is it makes you think critically, because if you ask a question, you got to keep digging into it. It makes you ask the question better.
Yeah,
it's like game theory. So I think it's going to be great for kids as they grow up and they use it and stuff. So
yeah,
it's pretty exciting. Yes. So continuing here, let's talk about. There's some stocks here pretty interesting. Actually, before we even get to that, let's go just about your process for. So how do you find your stocks? I mean, I like to ask that question all the time. Some people use screens, some people do technical, some will read press releases. I'm all the above. Take me through a process, and how low will you go on a market cap too?
Yeah. So generally I kind of consider 50 my low for a new entry. But if I buy a stock and let's say it dips below that, I'm okay holding it usually. But yeah, 50 million is kind of the bottom that I would look at. So things above 50. It just the reason really is below 50 million, it becomes hard to become a public company, and actually, unless you have a really solid growth trajectory to actually kind of get enough momentum to kind of get out of spending the $1 million or so that it costs to become a public company, to remain a public company and actually getting money. So that's kind of why I use 50 as kind of the bottom. But yeah, in terms of screening and looking for new companies. So I do a fair amount of screening. I have a number of different screens that I kind of just like pull ideas out of. I do a fair amount on Twitter where I'll just kind of like ask people what's the 10, what's your favorite company that has these characteristics or things like that, and I'll kind of pull them off there and just kind of take a peek at them all. I have an investor, kind of like a network of different investors, small cap guys that'll shoot me ideas here and there, and I'll go to pitch dinners and things like that. So yeah, those are the main sources. I have a bunch of different watch lists that I watch news for, especially on the microcap side. Like a name that, I think is interesting, but it's not there yet, or needs to, reposition, or I'm looking to see if like their new product is actually growing or something like that. I'll kind of keep those on a watch list and just check the news on that, every day, and see if it really changes and pops out.
Okay. And what tool do you use for screening, Sean? Are you a bunch of tools? Do you using Bloomberg? Are you using a out of the box tool?
Yeah, so I'm actually a big fan of Koifin. I am a Koifin subscriber. I think it's like $45 a month, and it's got everything I need. They just added a screener like 6 months ago, and it's pretty good. It does. I like it because it's not just US, it's international as well. So you can kind of screen. You can pick which companies you want to screen. I like that one. I'll go on Morningstar sometimes when I'm looking for quality stuff, just because I feel like they do a pretty good job of assessing moats and things like that. So when I'm kind of looking for more quality companies, I'll kind of go on there.
Okay.
And then, yeah, just kind of like word of mouth and things, keeping up on Twitter and making sure that, making sure I don't let anything fall through the cracks.
And how important is interviewing management? I mean, some people don't do it much, some do it. Where do you kind of?
Yeah, I think in micro caps, I think you've got to. Like I said kind of earlier about management, you really need to understand management. I mean, if you get a manager that is, self-dealing, or, a poor capital allocator or something like that, even if you've got a great company with a great product, or if they're just overspending on, executives or whatever, they're kind of like looting the company. I feel like you have to talk to managers, at that size, and usually they're pretty open. I haven't really found too many companies under kind of like 1 or 2 billion that aren't open to chatting with just the, probably even like private or, private investors.
Right.
So, yeah, that's part of my process. I usually reach out to them with some questions and try to get a call. And a couple of companies that I've owned for a while, I'll talk to quarterly. Yeah.
Okay, great.
Yeah.
And earlier you said you have, I guess your core positions, you're looking at a 3 to 5 year time horizon.
Yep.
To some degree, but I think you do some short-term stuff too here and there. I mean, and so
yeah, that would be more what I would call like special situation stuff. So I have a number of different kind of special situation targets that I kind of, or like types of special situations that I've had success over the years. So like one that has actually been worked really well is the January effect on kind of like small micro caps. So I don't know if you're familiar, but basically due to tax loss selling in December, like a lot of small caps, especially because they're very liquid, you will trade down at the end of December, and then kind of in January, everyone will come in and buy all these small micro caps up. So I've had success doing that. I will keep an eye out because of the short selling. Occasionally, I will find a stock like we talked about where I just feel like the momentum is behind it. There's going to be a huge squeeze on this thing, and I'll go long for a short period of time, to take advantage of that. And then I do a fair amount of, spin-offs and things like that. Usually buying the spin co, but it kind of depends on the situation.
Okay, awesome. Yeah, so I think I also do a mix of those two. I have hopefully my multi-bagger portfolio with 3 or 4 or 5 of them maybe sitting there, and then have some fun with some short-term stuff too. I do a lot of I'll do some special situation and like catalyst kind of events, but I do a lot of trying to find some of these stocks in the meat of a growth cycle. If I know they're haven't been growing, then reaching maybe a 6-quarter growth cycle, trying to capture that, and then leaving it. That's kind of worked well for me a little bit too.
Yeah, I've been thinking a lot about that lately, actually. Is buying the growth stocks when when the multiples come down, but like the core business really is just kind of hit a pause. There's been a lot lately, especially since COVID kind of rolled over and everything, where I've been taking a look and like, well, the core business is really growing higher than it looks like.
Right.
If you just look at this on paper, just because it had such a great year in 2021 or 2022 or something, So I think you're right. That is, I haven't perfected finding those out. So if you have any good pointers on how to figure that out.
Yeah, sure. I mean, actually, so I've been running I wasn't going to talk about it, but since we're talking about it, I'm kind of running a testing a new product out, which I haven't launched it yet.
Okay.
Yeah, I have geo investing.
Yep.
And I have this new asset that I'm building right now, and it's got some tools for the nano cap area.
Yeah.
I'm also doing this thing. It's called Cliff Notes, and it takes me back to when I was a kid. So when I was a kid, I used to, really just quickly look at a stock, write some Cliff Notes down.
Yeah.
What are my research tasks? And then I would have the buckets. I like it a lot, don't like it, never really like it, and I kind of went back to it. It wasn't working too well after '08 for a period of time. We can talk about that later sometime. But now that we're back to quality matters again, it's kind of working again. So basically what I would do I would look for these companies that were, in this tier 1 quality bucket, like an RCMT. I think you own RCMT.
Yes.
I don't own it now, but I love the company. We'll talk about that's one of the stocks I want to talk about. I think it's one of your favorites because you talked about it in your letter here.
Yeah. Mm-hmm.
So, RCMT was just a company, I don't want to call it broken, but nothing was going on for maybe 10 years.
Yeah. Mm-hmm.
And then all of a sudden they did some things that are really well, versus other IT staffing companies. And they're not just that. So I just, okay, well, they're about to hit this inflection point of growth, right? And so at least 6 quarters of growth, I think. And, they have a low PE, and you buy it right before that period starts. Now, when we bought it, when I did actually buy it, in 2022, they had a spike from like $7 to $30.
Yeah,
if you saw that, we
had on the chart. Yep.
We had that. I had that first run to maybe in the 20s. Then it's pulled back all the way down. Right, I'm looking at it again.
Yeah.
And so I basically am looking very specific for that. So it's basically momentum plus GARP. So I'm looking for stocks either on the 3-month high list, or the 12-month high list, trying to find out if there's quality there, if there's quality, and are they undervalued, or if they look overvalued, are they going to be undervalued soon based on what my forecasts are or analyst estimates.
Yep.
And so I've been running the strategy now for basically 16 months now, maybe.
Okay.
And so there's 65 stocks on the list now, and basically it's all passive.
Okay.
Once I put the stock on the Cliff Note, it's pretty quick thinking. I'll write a note. And I don't even do anything. I don't have any sell. I just want to see what's doing. And it's up 25% by doing nothing over 65 stocks.
Wow.
and it's like, 2/3 went up 20%. There were maybe 16 doubles or something like that. And it was really, really weird. So now I'm like, okay, now what if I actively manage now? What if I go passive? Am I going to screw it up, or is it going to be better?
Yeah. Is it going to be? That's a good question.
Yeah. But so that's all in this GARP momentum, kind of thing. And so I'm pretty happy. So that's what's kind of like, you'll hear people talk right now about how bad it is, like in small cap land, right?
Yeah.
If you look at the indexes, it'll look like that. Russell really isn't a small cap, but like IWM, whatever.
Yeah.
If you look at some of the true ones, like I think LD's got one, I think Bobby Kraft's got one, and they're down like 20 or 30% over that same period of time.
Yeah.
And, if you look under the hood here, there's this GARP nano cap is back. I think it is back, and it makes a lot of sense because the quality is back again. Rates are high, inflation, people want more quality. And as people are losing money in the moonshot companies you talked about, and they're going to keep that money's going to eventually come out if they have any left. If you sell before it goes to zero, all the money's going to go back, hopefully go back into quality, right? And so that's
especially with how large caps just so expensive now too. For the most
it's
part.
crazy, yeah.
There's like CPG companies that used to trade at 12 times earning that are trading at 30 now.
Right.
Which doesn't make sense to me in like a 5% interest rate environment, but I guess is just people are okay paying up for those large companies. But yeah, I'm with you. It seems like there's definitely a ton of quality small cap companies out there that are trading, really cheaply,
right,
previous years, and still growing really strongly. And a lot of them are either cash flow positive or even net income positive. So there's I've shifted a fair amount. I kind of talked about the 3 buckets. I'm actually heavily weighted on the microcap bucket right now because I just think there's just so much opportunity in that space right now, compared to quality is really expensive on the high or the when you get up to the higher market cap stuff, and special situations been okay here and there, but that kind of depends.
Cool. I mean, how important? I mean, obviously you're reading SEC filings, and are you doing any Canada, by the way? Are you doing?
So yes, I do. Actually, it's I have it any U.S. Any English speaking OECD country. So U.S., Canada, most of Europe, and Australia.
Okay, awesome.
I have I think 4 Canadian companies right now.
Excellent. I think one of your companies just got acquired. Was that Canada? Or was that U.S.?
That was U.S. That was Neo Games. Yeah.
Okay.
Yeah.
Congratulations on that.
Thank you. Yeah, it was honestly, it was a kind of I think they kind of overpaid for it, but it was a good company that basically they just had an acquisition that closed maybe like 6 months ago that basically like made them kind of like a full-on gaming company that could offer both the lotto side and the casino side. And I think that's why they wanted them. But yeah, I think it was like $29 a share or something off of, I think it was trading like $12.50 the day before they.
Oh, wow.
It was a good day for me.
Yeah, that's great. So we'll talk about, I want to get your performance in a second because,
yep.
But I want to talk before I get into the good news. Let's talk about some war stories. Do you have something you like, a bad investment that you learned some lessons from, or that you want to talk about and share?
I kind of mentioned Tilray, and this is more like a cautionary tale on short selling, I would say.
Okay.
But yeah, I shorted Tilray, so they IPO'd at like $25 or something. I probably shorted them at $60, went up to 200, and went back. I think it's trading at like $1 now or something.
Wow.
So, but yeah, the tail there, and this is why I keep my shorts small. And also I actually sold some calls into it as well, which was very, very painful.
Right.
But yeah, I don't, I do a little bit of options, but not nearly like years past.
Right.
But I think that the story there is really, you really need to be cautious of new IPOs that have really restricted floats.
Okay.
In that specific case, what ended up happening was because it was a cannabis stock, and it was essentially like a biotech stock as well. There were a number of ETFs that basically bought into them just to get them in the index, right? And that indexing basically caused there to be very limited shares for basically the public to come out and buy. And once it caught fire, I think the algos kind of took over and they just grinded it up every day. And eventually, eventually it peaked one day. I remember like waking up. I think it had closed at like 125 or 150 or something the day before, and I woke up and it opened at like 220.
Oh, geez.
And it went to 250, and then it fell to 160 or something all in one day.
Wow.
It was wild, but
wow.
Yeah, and so yeah, you got to risk manage your shorts, especially, and you got to make sure that you check the float and the short interest as well, because it is.
Right.
That's how those squeezes happen.
Yeah, especially these $1, $3, $4 stocks that are going to zero, but they'll have these pumps before that to raise that money, and that can get you too.
Actually, filing for bankruptcy has been a very bullish thing lately.
Yeah,
file for bankruptcy, the stock's up like 200%.
Yeah, it's crazy.
I've never seen that before, but
I like buying stocks out of bankruptcy when they restructure and they come out with new stock. That's really a good place to be sometimes. But yeah, during is weird. I think that usually there's a minute percent chance that the stock doesn't get canceled and there's still some value to it. But even if there is, it's going to be a fraction of the value that it's trading at. Right.
So, yeah.
Yeah, it's pretty
Yeah,
amazing.
if you want to spend the time, and I know a couple investors that do this, where they mainly do bankruptcy related equities, and if you want to spend the time, and you can actually go to the court, bankruptcy court and stuff, and you can be 10 or 20 minutes ahead of the market, by sitting in the court.
Oh,
There's a couple
nice.
services too where they'll actually have a guy like go there and tell you what the outcome is from the bankruptcy court
Oh, really?
the day, like if like if the
Yeah.
equity gets to retain any ownership in the company, or what the actual deal is or whatever, because it's usually decided by the judge in the bankruptcy court. So they'll have they're quite expensive. I think it's like 15,000 a year or something, but you can be the first one to know
Right.
about the weird bankruptcy and court in Texas or something.
Just
But
hang out
most
in
of them are in Delaware, I
hang
think.
out in court.
Yeah.
Yeah. So let's talk about some of the we'll top it off with some of the positions that you have here in
Yeah,
your
sure.
portfolio. And I think what's gone alongside, that's more and more interested here.
Yeah.
People and I think that you have, I think, what is it, 10 positions?
I
Or
show
that's your top holdings,
I show my top five. Yeah, there.
your top five. Okay, you have five short, five long. I'm sorry.
Yep.
So Atlas, I think they're Canada.
Atlas is
Atlas,
Canada.
yeah.
Yep.
You got
Yep. Out of
RCMT, which is
Vancouver.
US. I know
Yep.
them. Then you got what is this one? Thrive Holdings, Thrive.
Yeah, that's US. Yep.
Okay.
That's
And Mercado Libre.
yep. It's US listed, but that one's that's the South American e-commerce company.
Oh,
So it
right,
would
right,
be
right,
kind of
right.
like the quality bucket for me there.
And Aden, right? ADYEN. So yeah, so out of all these, is RCM your favorite? Maybe it's not. I mean, I spoke out. I just saw
Um,
you wrote a lot about it here in the.
Yeah, I try to highlight one investment specifically on the long side with each letter. Yeah, RCMT is definitely one of my favorites right now. I really like the management. I think they're really focused on building RCMT into really like $1 billion company. The two guys that run it, Brad Vizzi, he's the chairman, but it's kind of like a holding company the way they've set it up.
It's
So
like
he's
a
the
co-CEO. It's like there's no like really see this.
yeah, there's no
Yeah.
CEO. They're CEOs of the individual three segments essentially, but I think they call them COOs. But yeah, Brad basically runs all the capital allocation, and he's done a wonderful job over the last 3 years, since I think he took over in like 18 or 19.
Mm-hmm.
But he's done a wonderful job. He's bought back about 25% of shares since COVID, and he bought 11% of shares back last year when the stock was at one point it was down to like $11 or $12. The CFO Miller, he's been pretty involved in all of the capital allocation decisions as well. And they've kind of like taken the portfolio that they've had, and they've tried to move it in a place where they kind of see like the growth coming. So they're positioning a lot of their engineering business around around new energy, the new energy transformation. So a lot around the grid, supporting the grid, biofuels, all that sort of clean energy stuff.
Mm-hmm.
They have a little bit of exposure to oil and gas, but not material. And then on the healthcare side, they have had a lot of success with the school systems. So
Mm-hmm.
they have contracts with some of the larger school systems in the US, and basically they provide them nurses. And during COVID, obviously this was a big issue, but it's kind of come off a little bit, obviously, as we get out of COVID, and there's availability of nurses is opening back up again, because people didn't have them for them. But they have they also are doing things with like therapists in schools, where they
Mm-hmm.
actually have where they're placing behavioral therapists, which is a new big trend in schools, to have a
Mm-hmm.
behavioral therapist at the school. And so that, I think that's going to be a big tailwind for them. They're still really early too on within the school system. So like they're not, they've hit a couple of the big ones, but they're not, they still have a lot of room left that they could expand.
So John, and to be clear, they're a staffing company, right? They have staffing.
Yeah. Mm-hmm.
And
it's talent services. So a lot of it is placement, healthcare, and they have an IT business as well. So those are kind of the three verticals.
Yeah,
the healthcare, the IT, and engineering.
So what I remember about this company is because a lot of these, there's other ones like NASDAQ, MHH, and a few other IT companies that didn't do so hot. TSRI.
Yeah.
And RCMT is the one that's doing well. And I think they did a good job really diversifying the business into areas that might not be as sensitive to the economy as other places. And when I had invested in it years ago, when it wasn't a great vol. It was like my payment broke even in it. And they had a lot more exposure to the oil and gas industry. And I think they've really kind of pared that back down too a little bit.
Yeah, they have. They've done a number of different things on that side. They're opening up an office in Germany right now to try to support basically that energy. So Germany, I don't know how much you know about it, but they have a kind of like a really tough energy situation going on over there with the gas pipeline being down and everything. Mm-hmm. And so there's a number of different energy projects that they're supporting over there. So that could be a material kind of like tailwind for them in a few years. Mm-hmm. They did an acquisition of a company called Talent Herder, mm-hmm. Which is more like in the kind of like the technology space. So it's very small, but they're pretty nimble and have shown great capital allocation skills. So I'm willing to see what they can do for the next few years.
Yeah, the stock right now is 2051. It's come off its lows. I think it was around $10. It had that big spike. Now it's back down, back up again. And the reason I kind of hit my radar, I mean, it hit a recent high along the way here. But if you look at like the growth on the EPS line here, I'm using Centio right here. So in 2020, they did $1.98. And that was versus 83 cents in 21. That was a big move.
Yep.
And the full year 23 looks flat at $1.98. But if you look at the quarterly numbers, they're going to start picking up in Q3.
So, yeah, it's the engineering. Their engineering business is back weighted for this quarter. So right. They built a pretty significant backlog, but the way that the business works, basically they fill those positions as the projects start coming online. So basically they sold a lot of those, projects, and then they're going to backfill. They're basically going to fill them in 3Q and 4Q. So you have some pretty good visibility that they're going to have a pretty good back half of the year.
Yeah, it looks like it. So Q3 starts a trend here of potentially like 6 quarters in a row of earnings per share growth.
Yeah.
But so maybe they're going to do $1.98 this year allegedly, and then another $2.39 in 2024. I mean, I don't think a PE of 15 is unrealistic to have on this company.
Yeah, and if you look at a lot of the competitors in the space, they tend to trade at like kind of like the low teens.
Right.
PE. So yeah, I mean, it's trading at what, like 9 now, maybe, or 8, something like that.
Yeah, and it may be a leader in the industry too. So why can't I get a higher PE than it's
Yeah, exactly. I think their school contracts are pretty sticky too. So I don't expect those to roll off or anything anytime soon. So yeah, it's definitely it's definitely a high cash flowing business too. I mean, they have a lot of cash flow coming off every quarter, and they've mainly spent a lot of it just buying back shares. But now as the stock's getting more expensive, I would expect them to do something different with it, maybe acquisitions or something like that. So we'll see. I guess this quarter. I think I don't know if they've announced when they report. Do they report? They said, I think it's coming up next week.
I think it is next week, right?
Yep.
The stock's $20 here. It gets a P15. It's a $30 stock. So we'll see if it can on forward numbers at least. Yeah.
Yeah, they should report into next week. So
cool. All right. Awesome. Hey Sean. So tell us about the performance of your fund. You've done pretty good here. Out of the gate.
So yeah. Yeah, so last year was a tough year, clearly for, I am definitely the fund is growth focused. So, growth was really hurt last year. So this year up 21% through half of the year. So a lot of that, it was kind of a combination of both the short and the long side. All the shorts really started to hurt in June.
Right.
But yeah, I got fairly, I guess I would call it lucky, but I was short a couple of the banks going into that banking crisis. So
Okay.
Signature Bank, as well as shorted a little Silicon Valley Bank as well. Not as big as Signature. So yeah, I did okay on the short side, and the long side has kind of been chugging along. Nothing crazy outside of Neo Games was very helpful.
Mm-hmm.
You know, when a stock doubles or goes up 150% overnight, that's always good.
Right.
But yeah, I think right now there's a lot of small caps that are almost at like 62-week lows. I mean 52-week lows, and are doing good on the top line, and I think we'll see some nice small cap returns here going forward. So that's kind of where I'm expecting the returns to come. Quality is quite expensive, I think.
Right.
It's hard to find, relatively cheap quality stocks. It seems like everybody kind of like, flock to the high quality and high return on investment type stocks as the bubble kind of wound down.
Right.
Maybe those come off a little and we can find some quality growth names, but
Mm-hmm.
yeah, it seems like it's kind of expensive right now.
Yeah, I agree with you. The value I think right now is really in that nano cap, micro
Yeah,
cap area right
yeah.
now for
Oh,
sure.
yeah.
If you can find it. Cool, man. Well, this has been great. We've been with
Yeah,
Sean
it's been fun.
Westropp, and Deep Sell Capital, right?
Yes,
That's your
yes.
fund, and we should do this again one day. Give an
Yeah,
update.
definitely. Yeah, yeah. You can follow me on Twitter. I know you already follow me at deepsellcapital.com or Deep Sell Capital on Twitter, and then the website is deepsellcapital.com. So, but yeah, this has been really fun.
Awesome, man. Well, thanks,
Very
Sean.
cool. All right.